Welcome to Griffonomics. We are really excited to have you with us today. It is Monday, May 25th, 2026, and we've prepared a highly specialized deep dive tailored just for you.
Yeah, we are getting into a massive, just a really radical restructuring story today.
Exactly. Imagine taking over $2 billion in quarterly sales and walking away with just $6 million in operating profit. That is a 96% wipeout.
It's staggering.
Yeah.
And that is the exact reality Whirlpool Corporation, ticker symbol WHR, is facing right now.
Right. So we are unpacking their financial restructuring after a, honestly, catastrophic first quarter of 2026. We have a massive stack of sources on the desk here. SEC filings, the Form 10K and 10Q, earnings call transcripts, and expert reports like stress testing Whirlpool's capital structure.
And, we're looking at navigating a radical structural turnaround as well. Lots of dense data to synthesize.
So our mission for this deep dive is to answer one big question for you. Is Whirlpool a highly mispriced, asymmetric turnaround play, or is it just a structural value trap destined to collapse under its own weight?
Well, the best place to start unraveling that is the epicenter of the damage. Their core market, which is major domestic appliances, or MDA, North America.
Right, let's look at the top line first. Net sales fell 7.5% year over year, dropping to $2.237 billion.
Yeah, but that top-line drop doesn't really explain the severity of the bottom-line collapse. Segment EBIT plunged from $149 million in Q1 2025 to a mere $6 million.
Which is just wild. The operating margin was crushed down to a razor-thin 0.3%.
Exactly. And the macroeconomic catalyst for this was severe. We saw the outbreak of war in Iran, which, really dented global confidence. It pushed U.S. consumer sentiment down to a 50-year low.
Oh, wow. So that triggered the 7.4% drop in U.S. industry demand.
Yeah, including a brutal 10% volume plunge in March alone.
But I have to jump in and push back here for a second. How does a 7.5% drop in sales wipe out 96% of the profit? The math just doesn't seem to add up for a company this size unless something is fundamentally broken under the hood.
So that really comes down to operational leverage. When you run massive capital-heavy factories, a sudden drop in volume absolutely destroys your profitability.
Right. Because faced with that demand drop, Whirlpool executed an aggressive 20% year-over-year production volume cut to clear outfield inventories.
Yes, but that aggressive curtailment triggered severe fixed cost underabsorption. That decision alone penalized the quarter by a staggering $60 million.
It's like firing up a giant industrial bakery oven just to bake a single cupcake. You were burning all the gas and paying the rent, but you have nothing to sell to cover the overhead.
That is a great analogy. And simultaneously, they faced post-President's Day promotional discounting. Plus, some really unfavorable price and mix dynamics erased another 275 basis points from the segment's margin.
But why was Whirlpool forced into such aggressive promotional discounting? Especially when raw material costs like steel and resins were hitting the maximums of their long-term contracts.
Well, it all comes down to a surprise legal ruling. But before we get into that, we need to be very clear with you, the listener. We are analyzing trade policy objectively here. We take absolutely no political sides, left-wing or right-wing.
Absolutely. We are simply reporting the economic impacts as laid out in the financial sources. No endorsements here, just the math.
Right. So in late February 2026, the U.S. Supreme Court invalidated tariffs imposed under the International Emergency Economic Powers Act, or IEEPA.
Which sparked a lot of industry-wide skepticism about the durability of tariffs in general. Right?
Exactly. Competitors anticipated these massive back tariff refunds from the U.S. government. That incentivized them to immediately slash prices.
Just to grab market share.
Exactly, which dragged the whole market into a brutal price war that failed to cover inflation.
So between the $60 million factory penalty and that price war, Whirlpool suffered a massive negative $896 million free cash flow burn in Q1.
Yeah, a burn that severe means management had to stop the bleeding immediately. And that led to the unthinkable.
Right. They made the very, very painful decision to pause the common stock quarterly dividends starting in Q2 2026. That breaks a 70-year continuous payout streak.
They paid 90 cents per share in Q1. So that caps their 2026 outflows at roughly $95 million.
Which is a huge drop compared to the $299 million paid out in 2025. This suspension preserves over $200 million in annualized cash. They desperately need that to build an emergency capital buffer.
Yeah, they really do.
But if you're an income investor who has relied on this check for decades, this feels like a betrayal. From a survival standpoint, though, is this just triage?
It absolutely is triage.
Yeah.
But the $200 million saved from the dividend wasn't enough to secure the company. I mean, Whirlpool is sitting on $5.6 billion in long-term debt.
Right, so they initiated a radical recapitalization. They executed a $1.1 billion combined cash raise.
Yeah, which includes issuing $575 million in 8.50% Series A mandatory convertible preferred stock, plus, some common share dilution.
And that preferred stock introduces a new $50 million annual cumulative dividend obligation. Wait, so they killed the common dividend to save cash, only to issue preferred stock that pays an 8.5% dividend. Aren't they just trading one expensive master for another to pay down debt?
Well, yes and no. Management is structurally deploying 85 to 90% of these proceeds to fund a target of more than $900 million in debt reduction in 2026.
Oh, so the explicit goal is to drag net leverage from 5.5x down to the mid-4s and stay below a $5 billion ceiling.
Precisely. And with the balance sheet somewhat medicated, management turned to defending their actual market share. Here, they have a massive geopolitical shield.
Again, we have to reiterate to you, our listener, that we are analyzing this trade policy objectively. We are not endorsing the politics behind it at all.
Definitely not. So in April 2026, revised Section 232 tariffs imposed a flat 25% duty on the full declared value of every major appliance imported into the U.S.
Which is a huge shift because it closes those old loopholes that were based solely on steel content.
Right. And Whirlpool manufactures 80% of its U.S. appliances domestically across 11 U.S. factories. Plus, they sourced 96% of their steel locally.
So this limits the tariff's impact on Whirlpool to a mere 5% drag on net sales. Meanwhile, it slaps international competitors with a crushing 10 to 15% net cost headwind.
It's a massive competitive moat, but despite that, the headline numbers look terrible. To see the true operational run rate, we have to bridge the massive gap between Whirlpool's GAAP and ongoing earnings.
Yeah, the GAAP diluted EPS was a loss of $1.43, but ongoing diluted EPS was a loss of 56 cents.
So the difference is bridged by stripping out severe non-cash and one-time hits, like a 32-cent per share non-cash equity loss that entirely wiped out the carrying value of their Bico Europe BV joint venture.
Wait, literally wiped down to zero?
Yeah, down to zero. And there were $32 million in pre-tax restructuring charges, too.
Right, and that's for the workforce and footprint optimization, correct?
Exactly, including $12 million in employee terminations and $18 million in asset impairments. Plus, there's this weird inverted tax anomaly.
Oh, right, a $14 million income tax expense despite running a $51 million pre-tax loss. Earning a loss but paying a tax expense is wild.
Yeah, it's a jurisdictional mismatch. And we can't forget the legacy M&A and EMEA exclusions, like a $75 million French Competition Authority settlement.
Got it. Now, those $32 million in restructuring charges aren't just paper losses. They represent the physical reshaping of Whirlpool's global manufacturing footprint.
Yeah, the company is executing a $150 million structural cost takeout target.
And $120 million of those annualized EBIT benefits are driven by footprint optimizations. For example, in Perrysburg, Ohio, a $60 million investment for a new facility yields $30 million in benefits.
And the Amana, Iowa modernization yields $70 million in benefits. Plus, shifting production from Pilar, Argentina to Rio Claro, Brazil yields another $20 million.
But they still have a gap to reach that $150 million target. They are bridging that using strategic sourcing and design to value engineering levers.
Right, using fewer or standardized parts.
But they aren't just cutting costs, though. They are pushing their largest price increase in a decade. We're talking a greater than 10% promotional price hike and a 4% list price bump in July. They are basically daring the consumer to blink.
It's a bold move, but time is not on their side. The longer the turnaround takes, the more expensive it becomes due to credit rating pressures.
Yeah, Whirlpool's debt ratings have been downgraded below investment grade into junk status. Moody's revised them from B1 to B2, S&P dropped them from BB plus to BB, and Fitch downgraded them to BB plus 2.
And these downgrades actively increase their borrowing costs. The real danger here is breaching financial covenants.
Right, because if their EBITDA stays suppressed, maintaining their rolling interest coverage ratio becomes highly stressful.
Exactly, and that restricts their future access to capital just when they might need it most.
Which introduces a terrifying paradox regarding how Whirlpool actually accesses its operational cash.
Yeah, they are transitioning from an unsecured credit facility to a senior secured asset-based lending, or ABL, facility.
And unlike unsecured credit, an ABL's liquidity is directly tied to a borrowing base of eligible collateral, which is primarily inventory.
Right. The amount they can borrow depends entirely on the inventory they hold.
In Section 2, we said they aggressively slashed production by 20% to shrink inventory and save cash. But if their new credit line is based on inventory, doesn't shrinking their inventory accidentally destroy their borrowing capacity right when they need it most?
It absolutely does.
Yeah.
That is the exact paradox they are trapped in right now.
Yeah.
They need lean inventory for costs, but bloated inventory for liquidity.
So let's bring all these threads together for you, the listener. Is the stock, which is currently trading at a 14-year low of around $42, a value trap or a masterstroke turnaround?
Well, the bear case for the value trap is strong. You've got a frozen housing market, 30-year low existing home sales due to the mortgage lock-in effect, and full-year guidance slashed to $3.00 to $3.50 EPS.
Yeah, if consumers refuse the 10% price hikes and just repair old units instead, the company continues to bleed.
But the bull case is really compelling, too. You got the $900 million debt clearing, $150 million in cost takeouts, and that impenetrable Section 232 tariff shield.
Plus, management projects generating greater than $300 million in positive 2026 free cash flow.
Right. Because the fixed cost base is so high, any normalization in housing will trigger massive operational leverage. That could launch margins back toward management's 9% mid-cycle target.
So I want to leave you with a final thought to mull over. Think about your own home. Appliances don't last forever. The war in Iran, inflation, and high mortgage rates can make people delay buying a new fridge for a year, maybe two.
Yeah, you try to put off the big purchase as long as you can.
Exactly. But eventually, the motor burns out. The repair versus replace breaking point is coming. And when it snaps, Whirlpool's massive, heavily protected domestic factories will be waiting. Risk defined, portfolio protected.